All right, so we're about 8 minutes or so away from the opening bell. Now, at this time, what I like to do is I like to refer to where we are a couple minutes before the opening bell at 9:30. And down here on TradingView, you see this little ETH, that's electronic hours. I like to toggle that to regular trading hours. Okay, and this is where we were yesterday at session close. Okay, so that price, you want to drop a line from there, and you want this to be really bold. It's going to really stand out, so that way you don't miss it. You can't misinterpret what it is, and then toggle right back to electronic trading hours. So now, what is that suggesting here? Here's that line now. Remember, 41.50 and a quarter. Let's go back to regular trading hours. 41.50 and a quarter is yesterday's closing price 15 minutes after 4. Okay, that's like the bell ring. Yes, markets still trade. It goes a little bit further than that. We're not concerned about that right now. I'm showing you how to look at how I'm internalizing price action at the open. The open is 9:30. When the bell rings, you see it on CNBC or financial news networks. Ding, ding, ding. The bell rings. Everybody's applauding like they did something. Go back to electronic trading. We're trading here now. So what does that mean? We're trading at a discount relative to yesterday's trading. So the retail trader sees what? A gap lower in response to where we closed yesterday to where we are right now. So because of that, whenever you see that difference between that, it is a likelihood that the market will likely pull up and try to gravitate towards that. Not immediately always, not all the time will it do this. It's just something that you're going to be measuring once the market starts trading at 9:30. The opening range, when I'm talking about the opening range, okay, this is for your notes, because if you're not taking notes, you're not doing this right. When you hear me talk about, okay, we got to watch the opening range. What time is the opening range? Well, it's from 9:30 to traditionally about 10 o'clock. So it's about 30 minutes. I give it about 30 minutes. Meaning inside that 30 minutes, I'm trying to measure the willingness for price wherever we open up at to get back to the previous session close. If it's a gap down opening in those first 30 minutes, I'm trying to determine, was there any willingness to want to see the algorithm reprice back to that level? If there is no immediate dire need for it to get back up to it, in this case, that means we're extremely bearish. And then I can turn my attention to deeper discount objectives that would be on a 15-minute time frame, the hourly chart, or a daily. And I would use those ideals or ideas to frame a bias. So when you hear me talk about opening range, it's specific to about a 30-minute time window, but I'm looking at that first 30 minutes to see if there's any interest for us to reprice back up to the previous session close. And unless you have this on your charts, it's kind of like a day trader's little secret thing. Okay, the traders that know how to do this, they're not going to want to talk about it openly, because it's just one of their little edges. But I've taught it for a long time, and it's not mine. Okay, it's just a simple little thing that it's a quirky little nuance that price tends to do. When everything went to electronic trading, it just so happens that these are some of the things that are offered with algorithmic delivery. It's a form of fair value, getting back to where we were yesterday. Think of it as support broken, now turn resistance. Well, it has to get up there to be acting as resistance, right? If it fails to make any meaningful attempt to get up there, that is an underlying weakness that spells further decay for price to reach lower. In that case, we would want to see it trade through the midpoint or consequent encroachment of the shaded area, which is that yesterday fair value gap. If it trades below this level here with the speed, we would expect it to go below it, and outside of that shaded area is low end. But we always have to give that first couple minutes at the opening bell at 9:30 New York time Does it want to retrace? Now, with that in mind, let's just play devil's advocate for a minute because we still have a couple minutes. From where we are right now, let's assume that the bell was ringing at 9:30 at this moment. Looking back, there's only this small little imbalance right here, which would be just above consequent encroachment of the new week opening gap of the previous week. So we're retracing back into that fair value gap, as I mentioned, 41.28. That's your line in the sand. So if it trades back above 41.28, it may run above it and then come back down to 41.28 or 41.31. If it supports it and starts to rally back to 41.40, then you would expect it to trade back to 41.50 because that's yesterday's closing price. We are still in a deep discount. Okay, and the way this is internalized is traders that want to be long or want to be a buyer, they're going to really feel comfortable with doing this because they think they're buying it really cheap. And their target would be back to yesterday's closing price at 41.50. I'm not suggesting that's what's going to happen. I'm just telling you the framework because I'm going to be leaving you, and it's something for you to observe and study. But as long as we're below 41.28, sell side liquidity and new week opening gap for this week, if it gravitates back to that, we're going back into the chop.